Chapter 1, we have two parts for Chapter 1. First, we're going to go through the guidelines, and then we're going to go through the financial statements in Part 2. So, what is accounting? Because that's a question you need to understand. Accounting is considered the language of business. It's how we communicate how a company is doing. It is the scorekeeping function of business. Accounting is also at the heart of every business. Okay, there are two types of accounting. The one we're going to cover in this semester is what we call financial accounting. We focus on providing information to outside user that's financial in nature, and we have to comply with generally accepted accounting principles known as GAAP. Then we have managerial accounting, my favorite part of accounting, which you cover in 116B, and this focuses on internal users, and we are not required to comply with GAAP because it stays within the company. Now, the definition of a business. It's a legal organization that attempts to create value by exchanging products with customers for money. There is the legal entity, the exchange of product for money or money substitutes, and we have to create value. Now, our governing issues are first generally accepted accounting principles, which is what you go through when you take 116A and 116A, and if you were brave enough and you took intermediate accounting, which also goes in depth of what all these principles are. And this is all set up by the Financial Accounting Standards Board, and that's a 7-person board. Now, financial accounting is a system that identifies, records, communicates information that is relevant, reliable, and comparable about an organization's business activities. What we focus on in this class is identifying, recording, and communicating. So we identify only a financial transaction. We record, we have a method of doing that. We discussed that in Chapter 2 and 3. And then we communicate, and that is with the financial statements. Now, accounting principles and ethics. Now, the things you got to remember first, what is a business entity principle? It means you've got to keep a business's activities separate from personal activities. A lot of small businesses violate that principle. Then we have the reliability or objectivity principle, and this is accounting information must be arrived at objectively and must be verifiable, which means you have to have documentation. You can't just say, oh, I think we made this much in sales. You actually have to have sales invoices. Now, the cost principle, it says whenever we acquire something, all that matters is what we actually paid for it. It doesn't matter what the fair value does. If we got something that's worth $100 and we got it for 20, we have to record it at $20. That's the rule. And then the last is ethics. We want accountants to be trustworthy and to perform their duties based on high ethical standards. And this is what they try to do when they make you a CPA. Now again, the role of accounting is to recognize, measure, record, and report financial transactions. Now there's two types of accounting. Probably in personal life, we do cash accounting, which is we only record things when cash is received or dispersed. So if we receive cash, we record that, and if we pay it out. But if we don't pay our utility bill, we wouldn't record it because we only record it when we disperse cash. And under general accepted accounting principles, we have to do accrual accounting. And accrual accounting says that we have to record a transaction when it occurs, and it doesn't depend on cash being exchanged. An example would be is if you make a sale and the customer says they're going to pay you in 15 days. You would have, under GAAP accounting, you would record it when you make the sale. Under cash accounting, you would not report it until they actually paid you. That's the difference. Now let's look at some accounting terminology. It's very, very important that you're able to differentiate because what you do when you do accounting is the first thing when there's a financial transaction, you need to know what is it under accounting terminology. So the first is what we call an asset. An asset is resources of the company that have future economic value. That means we don't consume them when we get them. Example would be cash, equipment, supplies, prepaid services, and accounts receivable. Now, an accounts receivable is created whenever a sale is made and it's on account. That means that on account they didn't pay you, which means you have to set up an accounts receivable. So you would record the sale and the offset would be accounts receivable because they owe you the money. Liabilities. These are creditors' claims to resources. These are usually pretty easy, and those would be accounts payable, notes payable, or salaries payable. Now, accounts payable is when we buy something from someone else and we tell them we're going to pay them in 15 days. That's what creates an accounts payable. If we bought supplies and we gave them cash, you would not create an accounts payable. However, if we bought supplies and said, hey, we'll pay in 30 days, then we would create an accounts payable because we owe them money. Now, stockholders' equity has two parts. We have owner's claims, and that would be common stock. And happens when we issue ownership in exchange for assets, which is normally cash. Dividends are distributions to stockholders, usually in the form of cash payments. They reduce equity whenever we issue dividends because we're giving them back money. Now, dividends are never an expense. Remember that. Net income is the difference between revenue and expenses. Other common names for net income include earnings or profit. Revenues are the amounts recognized when the company sells products or provides services to customers. Expenses are the costs of providing the products and services during the current period. Every financial transaction must fall in one or more than one of these categories. Now we're going to go on to the infamous accounting equation. And what you have to remember is that assets equal liabilities plus stockholders' equity. So this must always be in balance. So here goes. We expand equity by saying that concludes contributed capital, i.e. common stock, less dividends plus revenue minus expenses. Now, less dividends plus revenue minus expenses equal what we call retained earnings. Retained earnings is how much of earnings a company has retained in the business that they haven't given out in dividends. So now let's take a look at an example of how things affect this equation. So the first thing we did is issue 10,000 shares of common stock for $75,000 and a machine valued at $25,000. So we would increase cash by $75,000, increase equipment, which is an asset, by $25,000, and on the other side of the equation, we would increase our common stock. And if you notice, they equal. The next thing, we would provide services for $10,000 cash. So we would increase our cash and increase our sales revenue. We bought supplies on account for $5,000. What that means is we got the supplies, but we didn't pay for them. So we have to set up that accounts payable. So supplies went up and accounts payable went up. We sold $15,000 of services on account. So accounts receivable will go up because they didn't pay us, and we have sales revenue. We paid for the supplies that we bought previously. So that's going to reduce cash and reduce accounts payable. We received payments from clients on account for $10,000. It's going to reduce our accounts receivable but increase our cash. You notice in that transaction, they stay on the same side of the formula, but they equal. We paid $3,000 in salaries. So salary expense went up and cash went down. We paid rent of $1,000. Cash went down, rent expense went up. And we paid $500 in dividends. Dividends went up and cash went down. Now what we're going to do is we're going to add up all of our accounts and we're going to get totals. Now here's what has to happen. All of these must equal all of these in order for us to be in balance. Okay, so when we add that up, we get this number. And we add these up, we get this number, which means we are in balance. Now, how do you report this financial information that you've been recording? We have to prepare 4 financial statements, and you prepare them in this order. First, you do the income statement, then you do the statement of retained earnings, then you prepare the balance sheet, and the last you prepare the statement of cash flow. We will be discussing these in part 2.